We live in a world that seems trapped in an unending cycle of crises, an era where each new upheaval not only shocks but also deepens the underlying fragility of our economic and financial systems. From the 2008 financial crisis to the disruptions of the COVID-19 pandemic, and from geopolitical tensions to climate catastrophes, the trajectory of global stability has been increasingly precarious. Yet, amidst this relentless turbulence, a more profound and insidious story unfolds, a story about the inherent weaknesses of the global financial system, the central role of fiat currencies, and the policies of central banks that prioritize immediate relief over sustainable solutions. The U.S. dollar, a symbol of global economic dominance, has long benefited from its role as the world's reserve currency. This unique position, underpinned by the petrodollar system, required nations to trade oil exclusively in U.S. dollars, creating a continuous demand for the currency and allowing the United States to finance deficits, print money, and sustain its global influence with minimal immediate repercussions. However, this system was never foolproof. No fiat currency in history has ever maintained its dominance indefinitely, and the dollar's position is no exception. The very mechanisms that granted it its supremacy have begun to falter, threatening a seismic shift in the global economic order. The unraveling of this system began quietly. As early as 2002, the Federal Reserve started repurchasing U.S. Treasury debt, signaling a decline in foreign investor confidence in America's fiscal stability. This marked a turning point, albeit one largely ignored by the public and policymakers. Over the years, this erosion of confidence has accelerated, driven by ballooning national debt, persistent trade deficits, and the aggressive monetary policies implemented in response to crises. Today, countries like China and Saudi Arabia are actively diversifying away from the dollar, trading oil and other commodities in alternative currencies. This shift is not merely symbolic, it signals the weakening of the petrodollar system and a potential flood of excess dollars back into the U.S. economy. When these dollars return, they will unleash inflationary pressures that could dwarf those experienced in recent years, undermining the purchasing power of ordinary citizens and shaking the foundations of global trade. Inflation, often dismissed as a temporary phenomenon or the result of isolated factors, is in reality a deeply embedded issue exacerbated by decades of short-sighted monetary policy. Central banks have consistently underestimated the complex interplay of factors driving inflation, as evidenced by the candid admissions of figures like Federal Reserve Chair Jerome Powell and European Central Bank President Christine Lagarde, who have publicly acknowledged their limited understanding of inflationary dynamics. The COVID-19 pandemic further exposed these vulnerabilities, with governments and central banks injecting unprecedented amounts of liquidity into the global economy to stave off collapse. While this approach stabilized markets in the short term, it also unleashed inflationary forces that are now proving difficult to contain. Despite recent dips in headline inflation due to temporary declines in energy prices, the full impact of monetary tightening policies implemented to curb inflation has yet to be felt. Historically, the effects of such policies take 12 to 18 months to materialize, suggesting that the most severe consequences are still on the horizon. The post-2008 era was marked by extraordinary measures to stabilize the global economy, including near-zero interest rates and quantitative easing programs. These measures succeeded in preventing an immediate collapse, but at a significant cost. They inflated massive bubbles in real estate, equities, and bonds, creating a system so dependent on liquidity that even minor disruptions now pose systemic risks. Liquidity crises in the U.S. Treasury markets since 2015 have highlighted this fragility, while the unprecedented inversion of the global yield curve, a phenomenon never before observed, signals deeper dysfunctions in the global financial system. Inverted yield curves, historically reliable predictors of recessions, now reflect a broader imbalance that could trigger a chain reaction of economic failures. Unlike the Great Depression of the 1930s, which occurred in a relatively disconnected world, today's economies are deeply intertwined, amplifying the potential for contagion. A collapse in one major economy could cascade through global supply chains, financial systems, and trade networks, with devastating consequences. At the heart of this fragility is the unsustainable nature of the fiat currency system, a system built on debt and perpetuated by the endless expansion of credit. When debt levels become unmanageable, governments have historically turned to hyperinflation as a means of erasing liabilities, sacrificing the value of their currencies in the process. This dynamic is not new. It has played out repeatedly throughout history, from the hyperinflation of Weimar Germany to the collapse of the Zimbabwean dollar. Recognizing these risks, central banks have begun preparing for a monetary reset. They have been quietly accumulating gold, purchasing at levels not seen since the 1960s, signaling a return to tangible assets as a hedge against the collapse of fiat currencies. Gold and silver, unlike fiat currencies or digital assets, hold intrinsic value and are free from counterparty risk, making them indispensable in times of crisis. Yet, central banks and financial institutions have also worked to suppress the market prices of these metals, creating the illusion of currency stability while positioning themselves for a future in which the current system unravels. The looming monetary reset will likely involve the introduction of central bank digital currencies, CBCs, heralded as innovations that will modernize financial systems and improve efficiency. However, these digital currencies represent more than just technological advancement. They are tools of control and surveillance, enabling governments to monitor and regulate individual financial activity with unprecedented precision. In a world increasingly dominated by authoritarian tendencies, the implications of such power are deeply concerning. CBCs could be used to enforce policies, freeze accounts, or impose negative interest rates, eroding the financial autonomy of individuals. These measures are often justified during times of crisis, with governments leveraging fear to implement policies that would otherwise face resistance. This pattern is not new. From the abandonment of the gold standard to the establishment of the petrodollar system, major shifts in monetary policy have always been accompanied by crises that create the conditions for radical change. Despite the mounting evidence of an impending transition, the general public remains largely unaware, lulled into complacency by narratives that obscure the gravity of the situation. Mainstream media and financial institutions focus on short-term market trends, ignoring the systemic risks that threaten the global economy. For those paying attention, the urgency of preparation cannot be overstated. Accumulating physical gold and silver, diversifying investments, and reducing reliance on fiat systems are critical steps for navigating the challenges ahead. History has shown that fiat currencies inevitably fail, and the signs suggest that this time will be no different. As the world approaches another seismic shift in the global financial system, the question is not whether it will happen, but when. Those who prepare now will be better positioned to weather the storm, while those who ignore the warnings may find themselves at the mercy of forces beyond their control. The stakes could not be higher. The choices made today will determine who thrives and who suffers when the inevitable collapse arrives.